Hi and welcome. I'm Ben. I'm a finance professor and I make finance videos. Today we're going to talk about an important paper. It's one of the most downloaded papers by finance professors in the last 5 years. The paper's called Do Stocks Outperform T-Bills? What T-bills are, they're treasury bills. These are government issued bonds that are very safe, and because they're safe, they have an almost 0% return. The first sentence of the paper says, the question posed in the title may seem like nonsense because it's widely documented that stocks outperform bonds, not only in the US, but abroad as well. That evidence is based on holding diversified portfolios though, not individual stocks. The reason the stock market outperforms is because of something called positive skewness. And what this means is, it means those very few returns that are very, very large offset the majority of the returns that are very near zero or negative. So what this paper does is it looks at individual stock. So the author, Hank Bessenbinder at Arizona State, he looks at all stock returns available from 1926 until 2016 when the paper was written. This is over 25,000 individual stocks. He looks at how stocks do in 3 dimensions. Compared to zero, like are the returns positive or negative? Compared to treasury bills, are the returns greater than treasury bills, the very safe government bonds? And compared to holding the market. He does this at 4 different intervals. So he does it at the monthly frequency, at the annual frequency, at the decade frequency, and at the lifetime frequency. So if a stock had its IPO in 1990 and then was acquired in 2000, he would look at the life of a stock. We're going to talk about that in this video. At the monthly frequency, only 48% of individual stocks had a positive return, only 48% of individual stocks had a return larger than T-bills, and only 46% of stocks had a return larger than the market. That's at the monthly frequency. Next, we're going to move to the annual frequency. At the annual frequency, 56% of stocks had a positive return, 52% of stocks had a return greater than treasury bills, and 44% of stocks had a return greater than the market. At the decade frequency, the numbers are similar. 56% of stocks had a positive return, 50% of stocks had a return greater than treasury bills, and 37% of stocks had a return greater than the market. Before we go to lifetime, I'll tell you a couple facts from the paper. The average life of a stock is 7.5 years, and the most common return for a stock over 25,000 stocks is minus 100%. 12% of stocks earned minus 100%, which means you lost everything. This is 3,000 stocks out of 25,000. Now looking at lifetime returns, only 50% of stocks had a greater than zero return. Only 43% of stocks had a return greater than treasury bills, and only 31% of stocks had a return greater than the market. So in this paper, only 3 out of 7 stocks outperformed treasury bills over their life. That's the answer to the title of the paper. 43% of stocks, just 3 in 7, outperform treasury bills. That's probably very different than you expected when you clicked on this video. Another thing the paper does to evaluate individual stock returns over the sample is something called a bootstrap simulation. And this means for every month of the 90-year sample, he'll grab a random stock. So in the first month, he'll grab a random stock. In the second month, he'll grab a random stock. In the third month, and so on for the entire period, and then calculate the return he would have earned. And then he'll repeat that 20,000 times. And this has a return lower than the market 96% of the time, and it has a return lower than treasury bills 73% of the time. So if you randomly pick stocks, you're going to lose to the market 96% of the time, and you're going to earn returns lower than treasury bills 73% of the time. Another thing the paper does is he looks at returns during the individual decades from 1926 to 2016. You can see that on the screen here. Returns are getting lower over time. It's harder to find positive stock returns in the recent 4 decades. You can see for the last 4 decades, the percent of returns that are greater than zero is right around 40%. And for the last 4 decades, the percent of returns greater than T-bills is around 30%. And for the last 4 decades, the percent of returns that are greater than the market is around 25%. The last thing the paper does is it looks at what's called wealth creation. And how he defines that is, that's the total value created above and beyond what someone would have earned had they invested their money in treasury bills. The total amount of wealth created over the 90-year sample in this paper is $35 trillion. Investors gained $35 trillion over these 90 years by investing in stocks. The paper looks at the distribution of this wealth creation. 5 stocks, ExxonMobil, Apple, Microsoft, General Electric, and IBM were responsible for 10% of the total wealth creation. That's 1 out of every 5,000 stocks were responsible for 10% of the wealth creation. 90 stocks were responsible for 34% of the wealth creation. So 90 out of 25,000 were responsible for more than 1/3 of the total wealth creation. And finally, 1,092 stocks were responsible for 100% of the total wealth creation in the 90 years that the stock market has existed. The remaining 96% of firms were responsible for 0 total wealth creation. So 96% of stocks created exactly 0 wealth for investors. So why should you care about this paper? Why should this paper make a difference to you? Because if you're trying to pick stocks, like in the sample, like in the bootstrap simulation, you're gonna lose. 96% of stocks create 0 wealth. So if you're picking stocks, you need to be able to identify the 4% that have positive wealth creation. Or you need to have a friend or an advisor, someone who can identify those 4%. You need to have special skills to be able to identify those 4%. If you cannot identify those 4%, you shouldn't be investing. And there are lots of guys on Wall Street who spend 40 hours a week or 60 hours a week or 80 hours a week trying to identify those stocks, and they're not able to. So please consider this data. 25,000 stocks. Every stock that has data available since 1926. Only 4% create any wealth. Are you able to identify those 4%, or is your advisor able to identify those 4%? Think about that question before you go ahead and pick stocks. Thank you for watching this video. If you're out there picking stocks, hopefully this video has some impact on you. Hopefully you all learned something about this, about what individual stock returns are like, what does the distribution look like. If you thought the video was useful, please click below and subscribe, and I'll see you guys in the next video.